This audio was recorded at Investments in Wealth Forum 2023. For full on-demand sessions from this event, they are available until August 15th, 2023. For more information and to register, please visit iwicentral.org/Scottsdale 2023.
We're proud to welcome you to the Exceptional Advisor podcast series, brought to you by the Investments and Wealth Institute. This series aims to help you to better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. Hi, I'm your host, Bob Powell.
Ladies and gentlemen, please welcome Bob Powell, our editor of the Retirement Management Journal.
Thank you, Ted. Thank you, everyone. Just a quick note about this session. It's a bit of an experiment. For those of you who are familiar with the Financial Planning Association, they would run something at retreat called Under the Tree, where people would sort of submit content, and then people would gather at lunchtime to talk about the topics that were generated right there on site. And so this is sort of a play on Under the Tree. Instead of doing it on site, what we did was we asked folks who were attending the session to submit ideas and topics and speakers that they would like. So this is a attendance-generated session. And so it gives me great pleasure. We have an hour to speak, and our first speaker is Jorge Padilla from Mira. And we describe this as a fireside chat, but it's going to be more of a presentation, but from these comfortable seats. So, Jorge, start us off.
Thank you. Thank you for having us. We'll go through some of the topics here, and we'll have Q&A as well. I'll leave a little bit of time for that. What I wanted to talk about is just some topics that I've come across over the years, especially many of them coming from clients, asking me like, hey, I want in on this Picasso, like how do I make it? Or I want to be investing alongside Mr. Wonderful, he's promoting all these equity investing platforms, so how do I get access to that? And the reality of it is nowadays it's a lot more accessible to do that because technology is democratizing access to a lot of investment asset classes or markets that before were accessible only to very high-end investors or with very high minimums. So that's something I'm very passionate about, like how technology is providing access to so much more, and also how new generation of investors are changing the way they consume information, but also how they access investment ideas. And they're expecting a lot more from advisors in being able not just to provide information, but guidance and meaning behind their investments. So I don't expect to cover very much in depth because we have a limited time on these topics. Each of these areas could have its own presentation. I want to really just focus on what basics you need to know about, why you should care, and maybe think about how you want to advise any investor about what role could you play in a portfolio? And perhaps ways that you can incorporate it into your practice if possible, because nowadays there are ways to do that. First of all, I wanted to touch on some, why this is happening and why you may want to focus on catering on these next generation investors that are looking for something different. I'm not going to spend necessarily a lot of time there are other sessions that go a lot more in depth about next generation investors, their profile and everything. But we all know that in a few years or in a decade or so, millennials and Gen Z are going to be the majority of the US population. And they are not just behaving different, but they are looking for more diversity in their, not just the lifestyle, but the people they interact with. They are a lot more wellness and health conscious. They are also looking for purpose and meaning behind their money decisions and how they invest money. And I think that's the key part that you need to think about is how do you incorporate those values into that decision-making process so that you have more engaged clients. The other part that I think it's important is, and we kind of seen this charts that, all the wealth that is going to be transferred, but I think there are some charts here that tell a very compelling story for you to think about how you want to build your practice and how durable you want it to be. Because a lot of wealth is going to be passed on to the next generation. And if they are thinking about investing in a different way, and they are getting exposed to different ideas, and they are a lot more comfortable with getting outside the box, the traditional stock bonds that most of our practice may have been built on, then you need to become well-versed at least on how to have a conversation about it, how to think about it, how to incorporate it into the portfolio in a meaningful way so they're not doing stupid mistakes of getting a lot of money into riskier things with no diversification. A stat that I saw in this Fidelity study, I thought it was really interesting. There is about over $300 billion that is being inherited by millennials already. So $300 billion in the US being inherited by millennials every year now. And it's just going to increase. And I'm sure you want part of that as well for your practice. So something to think about. This other chart, I think, tells also a very compelling story about value of each practice, like showing a more elderly client that you have a lot of assets now, you have a healthy revenue coming in, but what's that progression over time going to be of that revenue? Very different story for a younger investor that is still accumulating and adding assets. So you may want to think about the lifetime value of that client. And if you want longevity and sustainability in your practice, you need to begin having more conversations with younger investors and learn what the language and what are the things that they care about. And I think this research study also touches on some of the themes that I'm going to touch on a little bit later, in that this new generation of investors, and many times is not just age. I've been getting these type of questions from Gen Xers, people in their 50s, because a lot of these platforms, or later, a lot of these companies are catering directly to investors, and they have marketing budgets that are larger probably than many of us combined. So that's something to think about. These people are a lot more comfortable getting outside the box, incorporating other type of investment strategies that are non-traditional, that is different, because everything that is tech-enabled and is easy is just more accessible to these folks. So, and nowadays that's possible. So, something for you to think about. And then lastly, I think we were touching on this in other sessions as well, and this is just the reality. Younger generations are looking for beyond the money management services that we've been providing for decades. They're looking for aligning their values and their purpose to their money decisions. And I think it's going to become increasingly important that our role shifts from just the money management to providing meaning to those money decisions that they have. And if we can provide meaning to how the investments are managed and where they're located, you're just going to have more engaged clients. And more engaged clients are more likely to stick around for years, even during the bad times. So now, touching on the different investment strategies that are non-traditional, I like this different periodic table to a little bit more expanded from the typical just sectors or the major asset classes. A few things I want to touch on. So why do you may want to care about each of these themes? What are they? Because sometimes may not be familiar to you. You may not have seen them. And then how you may want to think about it as part of a portfolio. The first one, really, this has been around for a long time. I think it's just becoming a lot more mainstream. And this is the concept of personalized portfolios. This is enabled by direct indexing. Direct indexing technology or services have been around for decades. Parametric was one of the leaders there. But it seems like nowadays, a lot of firms are jumping into the bandwagon. You've had JP Morgan acquire Open Invest recently. You've had Schwab acquire Motif, which was like a thematic stock investing platform. And there are a lot of firms providing these services. The reality of it is it's about having a conversation with your client on what is important to them, how their views of the world could be reflected or could be incorporated into how their money is being invested. Because through this technology, you can still incorporate all that and have a diversified portfolio, have the proper exposure to the different sectors or asset classes, doing so in a cost-effective manner, and hey, guess what? It's also potentially more tax effective, right? So, something that nowadays, this is a toolkit, this is something that is in our toolkit that is just about having a conversation, being well-versed on what the possibilities are and incorporating into the practice. The numbers here, or the print on the kind of the diagram there, is difficult to read, so I'll just touch on it. But this is saying, 90% of investors in the US want their investments to reflect their personal values. 90%, that's a big number. So again, how can you incorporate these in the investment decision? 86% of US investors think that incorporating ESG can be a good thing for the investment. Again, that's 86% of people in the US think about incorporating these values-based or these screens is a positive thing. That's a large number. You may argue afterwards whether that's a good thing or not, and whether it's greenwashing and all those things, but it's all about the quality of the screens or the quality of the data that you have and how you put it in practice in the portfolio. And I think that's just getting better and better over time. So again, just like you have a risk profile for clients, risk tolerance, just incorporate a values-based questionnaire in how you invest money. How can you incorporate those values, those themes, those preferences or causes they care about or they don't want to support with their dollar? Another theme here, cryptocurrency or digital assets. I'm not going to expand a lot in here because I think there's been a lot of articles and things over the past few years about crypto. You may like it or hate it. I don't care. The reality of it is going to stay here. I've done presentation of the topic. I know this is going to stay around. Huge banks are building the infrastructure to custody these assets. Blockchain technology is going to revolutionize a lot of industries and a lot of operations. And if we're going through what was considered a Lehman Brothers moment for crypto, large firms kind of going under, but this is just going to make those that stay in the game a lot stronger to be able to build from here. And the truth of the matter is, a lot of investors, a lot of people in the US already own or have transacted with crypto in the past few years. And that's the reality. If you're not having these conversations with your clients, know that they're getting this information somewhere else. Because when I started having these talks, I started realizing there's a lot more clients that own crypto that I had no idea about just because they didn't know we could offer that or we knew anything about it. So just get familiar with it, have the conversation. And if you choose to, nowadays there are a lot of platforms and companies that are providing qualified custodian services and log into your technology platforms to be able to manage this in a portfolio. And think about it as an alternative, right? Whether it's a 1% allocation or 5% allocation, think about it as an alternative. It could be part of a portfolio. Marketplace lending. This has been around for over a decade. Some of you, I don't know if any of you have taken any personal loan from Lending Club or Prosper. Chances are you probably haven't because you're good planners. You have your emergency fund. You have built up savings. You don't have to get personal loans. But the reality of it is these platforms have issued a tremendous amount of loans over a decade. Lending Club, SoFi, these are publicly traded companies. There's now a huge institutional pool of capital that are buying these loans in bulk. Some of them are securitized. But all these years and still today, any investor can go to these platforms and create their own portfolio. And it's very enticing because, hey, you can get 10, 15% yield on these loans. Like for anybody that wants a different kind of investment experience, like why not? And you can do it yourself and kind of do it online in an easy to use platform. So why not? So some of the things that you need to think about here is why this could be part of a portfolio. I mean, the most attractive thing really is the high yield that they offer, right? And based on investment results over the years, it could also have very low variability of returns or even low correlation to markets. So if you're having a high yielding asset and also low correlation to stocks and bonds, that could be a good addition to the portfolio. Now, the issue with these is that you have to have diversification. we've seen so many studies about the stock diversification, how many stocks you need to have a diversified portfolio. And I think with these platforms, especially with loans, where it's more of a binary outcome, if you go through a default, you may not get your money back. If everything goes right, you get your money back plus the interest. So there is no upside. So even more important than in these cases, you get the most diversification as possible. This chart is done by Ground Floor, which is one of these platforms, and it's showing you the outcome that you can get depending on the number of loans that you have. And if you notice, the more to the right you go, which is the larger the amount of loans that you own, the more likely you're going to get that 10% return, which is the average yield that those loans have offered. So again, diversification here is super important, and not just have a dozen of these, you need a lot more to get there, to have more likelihood you're going to get that return. So this is where it gets tricky. With some of these minimums are very small, but other platforms have minimums that are very large. And it's managing that binary outcome or that diverse outcomes you can get is the tricky part, especially for retail investors that want to do it themselves. So what I'm going to show you a few different charts on actual funds that you could access and put in a portfolio. These are two interval funds. And for those that are not familiar with the interval fund structure, these are funds that are generally illiquid, but provide 5% of the fund assets to be redeemed on a quarterly basis. So they can access some of the more illiquid areas of the market, like marketplace loans. So these are two that are live. You could see the returns. It's almost equity-like return since 2020, and you're going through a recession and everything, and it's still a pretty attractive return with very, very low volatility. So something, if you want to incorporate that area of the marketplace, there are funds available for you to do so. Private real estate platforms, I'm going to talk a lot about the why. Everybody's familiar with real estate. I think it's one of the most compelling areas, one of the most compelling things that everybody is familiar with it, is comfortable with it. And the thing is, you have these platforms, again, catering to investors directly. So Hairdryer, Realty Mogul, Yield Street, Ground Floor. It's very attractive to look at these opportunities with 18, 15 double-digit returns, and clients want to jump on them. So we run into the issues of, okay, how do you properly diversify? Because every one of these is like $10,000, $15,000, $25,000, $50,000 minimums, and you're gonna need a bunch of these to properly diversify. So not for everybody. The other part is, taxes on these, especially if you're owning directly, could be very interesting. Could be a very tax efficient way to access these strategies. And then also another consideration is some of these platforms provide 1031 exchange qualified properties. So something to look into if you have clients under that category. I think, specifically in real estate, it's important to put things in perspective on the risk spectrum and how risky is each of these deals. How do you get diversification from different geographies, different property types? And when a client comes and asks, I want to buy this apartment building or a fraction of it, like, okay, so how do you build a diversified portfolio of private real estate? Because just one deal in one area, it may go wrong and you may lose a lot of money as a result. It's through that diversification, you're gonna get that possible outcome afterward. Some returns here of, again, interval funds that are live and how they've performed over the last 2-3 years. I've added here Blackstone BREIT because it's such a large player in the space. But I think the ultimate picture here is the returns can be pretty compelling. Another area of real estate or kind of real assets. So I've had clients come to me and say, I want to own a piece of this vineyard. Like, how can I do it? Then it's kind of the same story, right? If you just go and buy the vineyard and put $25,000, the numbers could be great, but it's like, when are you going to get the money back? You just don't know. You're depending on the platform to decide when is the time to sell. And especially with farmland or timberland, there's not going to be a lot of movement there. So getting proper diversification on these, especially with $25,000 checks, is going to be very difficult. And I think that's where clients get lost on. It's very enticing numbers and return projections, but how do you make sure you get that when there is so much likelihood that just one deal may not go right as intended? And you don't even know when you're going to get the money back because you don't have control over the time frame to sell. For those of you that are not totally familiar with return expectations on these asset class, it's been a very attractive place to be for the last few decades. I mean, you get higher return than stocks and very low volatility. There is one interval fund that invests in private real assets, timberland, farmland, etc. Is not earth-shattering returns, but you're getting that low volatility, decent, like high or mid-single-digit returns there. Private equity crowdfunding, I'm going to touch very briefly. It can get very complicated here, but I think the Start Engine is the largest platform, and I think it's impressive how they've grown. I mean, last year alone, they raised more than $200 million in capital. This is in a very awful year for the markets. They have over 1 million investors in the platform. So it's getting larger and larger, and it's very enticing to say, okay, I'm going to invest alongside Mr. Wonderful or another shark. I think the key here is 50% of small businesses fail after 5 years, and not a lot of them have a liquidity event. So you just don't know when you're going to get your money back in a liquidity event. So that's where it becomes really difficult to diversify here and get a proper portfolio structured. So many times in these, especially, probably access high quality managers and see what you can get on a more diversified manner. Some interval funds that provide private equity exposure that you may want to think about if you want exposure there in that asset class. And lastly, I'm going to touch very quickly on fine art and collectibles. People are very familiar with this, but we hear news stories about art pieces selling for so much money, or these collectible sneakers or jewelry selling for so much. And the key here is this is a true shrinking supply issue because there are no more Picassos that are going to be painted. And if you have more high net worth individuals seeking these high trophy, high collectibles, high value trophy assets, price is going to continue to go up because there's no more of it that is going to be made. Platforms that offer this, Gill Street, primarily Masterworks, where you could own a piece of all these Picassos or Warhol or these artists. And Rally is also interesting if you want to have access to all these memorabilia, cards, etc. Again, here the other issue is diversification, right? The chart there is showing the more you can diversify, the more likely you're going to get a positive outcome out of this and get a decent return. That over time, it's been pretty good. And this is a data from Masterworks where you could see fine art over the last 25 years producing more than equity-like returns, and of course, truly non-correlated and diversified. So with that, I think I've run out of time. Happy to answer questions and any curiosity you have afterwards, and talk about these other areas or all considerations, custody, reporting, how you want to incorporate it into the portfolios, etc.
Thank you, Jorge. That was great. Appreciate that. So I'm going to turn our attention to, again, drill down a little bit on Gen Z investors, playing off what the previous session had done. I'm going to be talking about a study that Morningstar did in 2020 where they looked at sort of retirement trends among Gen Z investors. And the first thing I'd like to make mention of is there's lots of debate about who's Gen Z, whether it's 95 or 96 or what year that starts. In this case, for Morningstar's purposes, it was 1995. More is getting known about the landscape of this new generation of investors. And one of the interesting findings in the study is that Gen Z may not be particularly familiar with finance. And one of my favorite stories about this is I run a site on thestreet.com called Retirement Daily, and I hire interns from Northeastern University to help me run the site. And each semester, I give the students a bonus and tell them to go open a Roth IRA and write about it. And last semester, one of the interns wrote a story that began something like to this effect. It said, before I received this bonus to open a Roth IRA, the only thing I had ever invested in were gummy bears. And so there is some truth to this notion that they may not be familiar with finance. And it's even true with my daughter. She's starting her first job in the workplace and got her first credit card and wanted to know whether she should pay the credit card bill the moment that she used the credit card to buy something. So there's some lack of knowledge in terms of who's familiar with finance. It's not universal. This is interesting in terms of their general emotional outlook. The finding here is that they report high amounts of happiness and optimism. And this sort of, for those of you who were attending Michael Kitz's session earlier today, he showed that smile chart that showed young people generally being satisfied with life. So this sort of mimics that finding that they're both happy and optimistic, Gen Zs. In terms of retirement preparation, they think about retiring early, earlier than prior generations. And I don't know if many of you are familiar with the FIRE movement, the financial independence retire early, where people are sort of maximizing their savings, spending less than they could, in the hopes that they can retire at age 30 or 40 or so, and expect that whatever sum of money that they've set aside to last 40 years or 45 years in retirement. I think this is just, in some cases, misplaced optimism that they'll be able to create a nest egg that will last 45 years in retirement, but maybe they can. In terms of activity, they want an active retirement. That should not come as any surprise. At the moment, they plan to save a little more for retirement, but the research seems to suggest that what they've done is save 6% of their salary, which is sort of in line with what they're being told to do, right? Save enough to get the maximum match from your company. So they're being auto-enrolled, they're saving 6%, but they're not necessarily increasing the amount that they're saving for retirement. So this may be inadequate, especially if they want to be a member of the FIRE generation. And I think when you think about your clients and their children that you may be advising, the thought is to make sure that they've at least maybe signed up for auto escalation in their 401k plan. This is an interesting finding in terms of retirement preparedness. They say that retirement is important to learn about, but on the other hand, debt is also a priority over saving for retirement. And this may not come as a surprise because so many children, Gen Z workers, have come out with high student loan debt. So they're grappling with this notion of, I've got to pay my student loans and save for retirement at the same time. And I'd say the good thing about the Secure Act 2.0 is at least there may be an opportunity for students to pay down their student loans and have their employer match that contribution as if they were saving for their 401k. So that could be good news. The other interesting thing, though, when they look at retirement benefits, they seem to place health insurance higher than retirement. They place life insurance higher than retirement benefits, and flexible work schedules higher than retirement benefits. And in some ways, that may not be surprising, right? The health insurance is certainly expensive. They're well aware of the expense of it. But I think what's really interesting is the notion that they want to have a flexible work-life balance. And I can speak to this directly. I have a son. He's 27 right now. He's working in the advertising field. And he was able to persuade his employer that instead of taking a 1-week vacation, that he would take 2 days a week over the next 6 weeks, work 3 days a week, travel down to Costa Rica, work 3 days a week on the clock, and then 2 days a week it would be consuming his vacation time. So he's become a digital nomad, and that flexibility is not only appealing to him, it's appealing to his peers. The American dream is alive and well for Gen Z. 83% of the sample in the Morningstar study desire to be homeowners and want to purchase property in the next few years. I can say, again, speaking from personal experience, I have another son who recently got married, and he's saving for retirement, but he's also saving to buy a home. He's been married for less than a year, and he's tired of paying rent that is $3,000 a month for rent. And he feels like that's just a waste of money, and he should be a homeowner like everyone else. So. And his peers are buying homes. They're in their late 20s. They're buying starter homes. And I think when you think about your clients and you're advising the children of your clients, perhaps this notion of setting aside money to buy for a home, it will be especially important to them, especially as you think about not just saving for retirement, but paying down their debt and saving for their first home. Financial apps are quite useful and are used. This is probably not a surprise to anyone, but many, including as the parent of 4 Gen Z adults, I can tell you that they're all on Mint or Credit Karma, or they are constantly checking their credit scores. What was interesting to me was I had a conversation with my son not too long ago, and he told me his credit score, whatever it was, and then he proceeded to tell me that he couldn't get it much higher because the length of tenure on his credit card, right, is such that he can't. Everything else is fine. He's paying his bills on time. His credit utilization rates are low, but until he builds up a number of years, he's not going to be able to increase his credit score. And I thought, when I graduated college, I don't even know that a credit score existed, right? But these students, kids, know more about their money in some cases than we ever did when we were growing up. And so I find it interesting, at least, that they're using technology to become smarter. And they're using YouTube, right? They're getting lessons on YouTube about whatever it might be. What's a dividend stock? What's an inverted yield curve? Whatever it might be, they're going out to get this information.
Or TikTok.
Or TikTok. So that's sort of interesting from my perspective is that these apps, they are confident in their financial knowledge. That may be to their detriment. We talked a little bit about in the last session about behavioral biases, and overconfidence may be something. I sometimes look at one of my sons who's investing in individual stocks and thinking that he's picked the next whatever Tesla or whatever Apple or something like that, and he's with his thumbs underneath his lapels, he says, "I'm pretty sure I got this one right." Financial education is important to them. I mentioned that they will go seek out knowledge. They won't necessarily come to you. They may not go to their peers, but they will use technology to go find out everything from which investment platform to use to how to tie a bow tie. So this notion of being educated is important to them. And then in terms of keeping them financially healthy, I think for the advisor, it's this notion that you may need a nudge, right? That there's this mix of they trust technology and may not trust humans. And so the important thing with your clients and their children is to show them the value of a financial advisor, right? Technology can get them from street level to curbside, but it may not get them to the advisor's doorstep. And that's where your clients may be helpful, is to bring them into the conversation when you're talking to your baby boomer clients, is to say, you have children, you probably have concerns about their financial future. We should talk to them about whatever, paying down debt and saving for a home, or saving for retirement, or buying art, or whatever it might be. So I think it would be helpful to start nudging and to encourage the use of technology as an asset. It might also be encouraging to have your clients bring their children in to do a financial checkup, right? It's sort of a non-threatening way to get them exposed to financial advice and to teach them that, it's no different from going to see your doctor on an annual basis to get a sense of, how am I doing? How's my blood pressure? How's my cholesterol, right? How am I doing with all my, my asset to liability ratios? How am I doing with my debt to income ratios? Whatever it might be, you can start this notion of giving them a financial checkup and reevaluating things, and then talk to them if they have not auto-enrolled, if they've opted out of auto-enrollment, to talk about the notion of the benefits of auto-enrollment. I can tell you that my son, when he first went to graduate college and got his first job, I kept telling him to sign up for his 401k, sign up. He never did it. And then one day he brought home the paperwork. So I signed him up myself, and I signed him up for auto escalation, and I just told him to hand the paperwork in, and and he did, and he doesn't even know that he signed up for auto escalation.
The power of defaults, right?
It's the power of defaults, right? And so I may have pulled one over on him, but it's for his benefit. So I think when you talk to your clients and the children of your clients, is this notion of don't sign up for auto enrollment. You're going to be signed up for auto enrollment, but don't opt out if that's the case. So I think I'm going to leave it there and turn it over to Jim. Jim is our dessert.
We'll be right back for a word from the Investments and Wealth Institute. Did you miss out on attending this year's ACE Academy Conference in San Diego? Not to worry. This year's top sessions are now available on demand. Earn up to 21 CE hours and expand your knowledge with top-tier speakers like Wharton's Professor of Finance, Jeremy Siegel, or financial expert Michael Kitces. Register today at iwicentral.org/ACE23.
Thank you, Bob, and thank you, everybody, for being here. Obviously, the first step of transferring wealth is you have to have some wealth to transfer. So I'm going to take a few minutes to talk about retirement income. And I want to begin, I hear a lot of people say, distributing wealth is different than accumulating, but I've never really seen anybody else that really digs into exactly why it's so different. I was a history major, and anybody who studies the history of science, Thomas Kuhn's book, The Structure of Scientific Revolutions, is a must-read. It is the book that popularized the concept of a paradigm shift. And one of the things he talks about is that when you have paradigm-shifting ideas, you will always be met with strong resistance from your contemporaries. And there's an old saying among historians that if you have those kind of ideas, they don't take hold until your contemporaries die off and the younger generation grows up and embraces them. So they say that science advances one funeral at a time, which is where the title comes from. And what makes retirement income so different is that accumulating wealth is a linear process, but distributing wealth is a nonlinear process and therefore governed by the laws of chaos theory. And I want to take the next few minutes to talk about 4 aspects of chaos that I think are important to understand with regard to retirement income. In the 20th century, there were 3 scientific revolutions: quantum theory, relativity, and chaos. And what was most revolutionary about chaos, more than anything else, was it directly challenged science belief that we lived in a perfectly predictable universe, sometimes called a clockwork universe. And the belief was if you knew the current state of a system, you could accurately forecast all possible future states. That sounds a whole lot like if you know the present value of a portfolio, you can calculate all the possible future values. And that does work only for accumulation wealth, though, because what happens is the laws of chaos so dramatically change the rules of the game that it truly is a completely different discipline. And what really illustrates it, this piece, if you saw Dana's presentation yesterday, she referenced a slide that I have in a paper. And this is what she was talking about. However, the slide she talked about shows a year-by-year progression, whereas this just kind of gives you the ending value. So, and the reason I sounded confused when she was up here was it's the one slide. I have written 5 papers. It's the only slide that shows up in every paper. I wasn't exactly sure which one of those papers she was referring to, but the point is, 2 people retire in the year 2000. The first one puts 100% of their money in the S&P 500 total return index. Over the next 17 years, they averaged 6.1% a year. And assuming they had no fees, they ran out of money after 17 years. On the other hand, another investor puts half of her money in T-bills and the other half in long treasuries, so 100% fixed income. She earned 4.8% a year over the same time frame, and assuming she had an annual fee of 1.5%, she finished the 17th year with $420,000 of the original $1 million still remaining. This flies completely in the face of everything the industry has taught the average investor, that you have to take on more risk to earn a higher return to generate greater long-term wealth. And this shows exactly in a very succinct way that retirement income truly requires a paradigm shift in thinking. And a couple of important takeaways. Risk and return are not predictors of success. The less volatile portfolio with a lower return, 4.8 and 6.1, and higher cost generate a better long-term outcome. So it really shows risk and return are not predictors. That means modern portfolio theory doesn't apply. It means the cornerstones of indexing, risk and return, are irrelevant. As we'll talk a little more, I think Monte Carlo analysis is an illusion of knowledge. And it's because when you're using flawed inputs like risk and return, it's junk in, junk out. So very important takeaways. We can't resist the urge to predict. And yet the most fundamental revolutionary thing about chaos was it's unpredictable. So this is the analytical reasons, one of them. I'm not a big Monte Carlo person. On the right, I won't go through them. A number of behavioral biases, they all point to the fact the average person is pretty insensitive to probabilities, ignores them completely as risk magnitude increases. And for a lot of folks, it really has a negative connotation. Second aspect of chaos, probably the most well-known, is the butterfly effect. Very simple concept. Even small, seemingly insignificant changes early in a process can dramatically change long-term outcomes. Now, the technical term is sensitive dependence on initial conditions. Initial is the key word there. The green boxes represent years 1966 through 1990. The numbers below them are the returns. The first row is the return a 50-50 investor would get. And what it shows you is the very first box, shaded in blue, their first return was a minus 2.9%. That's not so bad. But look at the long-term outcome. Started with $1 million, finished with $94,000. The second investor, as you can see, began in 1 year later, 1967. That investor had the exact same returns in the exact same sequence for 24 straight years as the first investor. The only difference, and they finished with over $800,000. The only difference in those two outcomes was that 2.9% loss in the first year. That's what the butterfly effect looks like. And that's why it's so important, I think, for people to work with professional advisors, because the average person is not going to understand the importance of this. The third row, the last one, also retired in 1966. They used a little bit of active management compared to the first guy. They used a 30-70 allocation the first year instead of 50-50. That flattened the initial return to a minus 0.04. And you look at the long-term outcome, they also skipped increases in cash flow in the 4 negative years, which are in the red font. That little bit of active management, and they finished with over $800,000. So this is why I think retirement, nothing offers an opportunity to represent the importance of professional advice and active management than these first two charts. Because I don't think the average person out there has a clue what goes on in terms of chaos theory and retirement income. And I would point, Monte Carlo's flaws are badly inputted, risk and return, and the inputs it does not capture, active management, are significant. So this is why I think Monte Carlo is just really is an illusion of knowledge. Third aspect of chaos is you need nonlinear thinking. You need to think different. Linear thinking, you solve linear problems with linear thinking, which is about following a process to get to the one correct answer. Nonlinear problems don't have one answer. They have multiple solutions. So you need to be able to see all the different paths you could possibly go down. I think investors have 4 goals related to cash flow. The first one, M1, is maximize early cash flow. M2, they want to maintain their standard of living, which is about the cash flow in the later years. Number 3, they want to minimize cash flow shocks. And that's about delivering some level of predictability to the cash flow. And the last one, M4, is about minimizing principal erosion. That's their legacy goal. Now, I see a lot of research out there based on the Monte Carlo approach, the systematic increase of cash flow. And I even see some of those folks say that they're maximizing the initial withdrawal, but they're not really. If you are automatically increasing cash flow every year, you're maximizing M2, the growth of cash flow. To maximize any one of these 4 will come at the expense of one or more of the other 3. So if you're using that systematic approach, you are maximizing M2. M3, I see a lot of folks doing research, creating predictable cash flow. And that's probably with the products that are available, annuities and bonds, probably the easiest piece to solve for. But again, if you allocate a lot of money to doing that, it could come at the expense of the other 3. So I think there's a belief in science. You see at the bottom, Benoit Mandelbrot once said, in science, there's a healthy opportunism to begin with the problems easiest to solve. And I think in this case, the predictable cash flow is the easiest part. But there's a tremendous amount of research. Neuroscience shows if you could present yourself as an original thinker, and you can create a personal brand as an original thinker, it truly kicks off a lot of benefits for you. People value original thinking. They value innovation, not just features and benefits innovation, but innovative thinking. So I think you need to be able to speak to all four of these. Now, you may put the bulk of your clients maximizing one or the other, but if you can present yourself as a creative thinker who's delivering personalized, comprehensive solutions, it'll go a long way to building a personal brand as a creative thinker. On the right, you see a number of cognitive biases. I won't go through them all. It's very counterintuitive. They all point to the fact that these are all biases that block creative thinking. And they all say experts are the most vulnerable to these biases. That the more knowledge you've accumulated, the more susceptible you are to making assumptions, to narrow framing, to mental dazzle, to all these things. And what some really interesting research Dean Keith Simonton showed, as you accumulate more knowledge on a topic, maybe when you start college, for example, you're adding more knowledge, you get more creative in your thinking, you're more open to new ideas. But as you get to a point, it becomes counterproductive. As you continue to add knowledge, you become more dogmatic, less open to new ideas. So that the creative thinkers of the world, the reality is most of you probably have more potential for truly creative insights than the average PhD out there. And what's interesting is I'm a big music fan. I saw an interview with Carlos Santana, and he said something that really stuck with me. And he said, most people look for greatness in others, not in themselves. But the reality is you have much more potential than PhDs to be a truly creative thinker, and it can go a long way for you. The last piece of chaos is turbulence. I'll mention the first three pieces are in a paper I wrote called Chaos and Retirement Income. The newest paper I have, The Vital Signs of Retirement Income, covers the material going forward from here. And turbulence is really interesting. If you've ever seen a cigarette in an ashtray and the smoke is coming up, it's going to come up in a pretty straight, orderly kind of flow. And then at some point, it'll start to swirl and whirl and become much more chaotic and disorderly. That consistent straight flow, when you study fluid dynamics and chaos, the straight, consistent flow is considered laminar, very important concept. And you want to have a laminar flow. And then when it starts to swirl and whirl, that's turbulence. What I did with this chart, the red line is the annual change in percentage change in account value. It's not the account value, it's the average, the percentage change year to year. So this is a hypothetical scenario. You earn 10% every positive year, and you lose 2% in years 1, 4, 7, 10, and 13. You see those on the data points on the red line. So the first year, you lose 2, you withdraw 5, and you have a 1.5% fee. The account value fell 8.5%. Now look at the next year after that, the green number, the recovery year, and you earned 2.9%. The portfolio changed 2.9. Look at each of those recovery years after those negative years, and you can see it's 2.9, 2.1, 1.0, and a minus 0.5. Now I drew a trend line, the blue line, and it touches every one of those points. And then you get to the fifth loss, and you see that it changed, it fell 3% the next year. And you start to see daylight between the blue and the red. And this is where I would argue is you're starting to move away from laminar to turbulence. And in physics, it is considered one of the great unsolved problems of physics of predicting that critical phase, that critical point at which you shift from laminar to turbulent. So I think what you have to do is look for some patterns. You know, Benoit Mandelbrot developed fractal geometry as much, he says in his book, as much from his visual ability to spot patterns as his math skills. So I did quite a bit of research, and I've identified a number of vital signs, one of which is the number of negative years. Now this is broken down into 5-year blocks. Some more recent research that I haven't written yet breaks it down on a year-by-year basis. For example, if you look at the first column, NN is number of negatives, first row is 0. What I found studying historical portfolios, there were 25 that had no negative returns through the first 5 years. And only 2 of those ended up failing with an 8% failure rate. Go down the next row, 46 portfolios had 1 negative year through the first 5. They had a 48% failure. 26 had 2 losses, 73% failure. And so if you're sitting down with a client and just using this, You can show them, it's the 5th year annual review. If you have sitting on an 8% failure rate, pretty easy to say, hey, let's increase the cash flow. If you have an associated 73% failure rate, probably pretty seriously want to consider skipping an increase that year. And you saw in the earlier slide, you don't have to skip a lot of increases to have a really big impact because of the butterfly effect. Now, if you're sitting on a 48% failure, this is where you guys really come in. You have to understand, what are the client's goals? Is it more important to increase cash flow, or do they have a big legacy goal that they want to leave to kids or charity or whatever? So what was really interesting is you follow this, and the green font is where the odds were in your favor, red it was against you. And I developed a target value for each one of these things. And again, as I said, the current research I'm writing up now, it's going to be show a year-by-year transition. So I think the key is it's so hard mathematically. The greatest physicists of the world have struggled to solve that transition, but I think this is a good way to address that. So once again, you want to keep it on that laminar consistent flow, because when I looked historically, I showed you a hypothetical. When I looked at it historically, every failed portfolio follows that pattern, that falling off a cliff kind of deal. And when I took those same portfolios and said they're accumulating wealth, every one of them stayed in a very consistent, orderly kind of flow. So I do think that's the key to managing a retirement income portfolio, so that there is some wealth to transfer to the kids. I'm just going to take a second on this. You see the second row, number of negative years, and it shows you those are the target numbers. Through 5 years, you want to have 1 loss. Through 10 years, 2 losses. 15, 3, and so forth, or fewer, even better if you have fewer of those. So each of those rows represents a different factor that I looked at. And on the right are some questions you want to ask to kind of gauge the health of the portfolio. The newest piece I'm working on, again, breaks it down on a year-by-year basis and actually shows a total of 18 different factors to look at. So I just want to let you know it's there. It's in the paper. I've written 5 papers. The Institute has been really kind to print those, publish them. 3 of them, I have an author's page on the Social Science Research Network, ssrn.com. The first 3 are on that site. The last 2 are more recent. The 4th one came out in September. The 5th one came out in December. They will eventually be on the SSRN site. But you can see the 4 things: unpredictable, butterfly, turbulence, nonlinear thinking. If you have any problems finding any of those papers, have any questions, you have my contact information there. I'm happy to talk. I am on LinkedIn and Twitter. I don't post a lot, but anytime I have a new piece of writing or something, I will certainly post that on there. So in closing, I would just thank you very much for your time, and I hope you find some of my ideas beneficial. And even if you don't agree with everything I've written, hopefully it'll help you think a little different. Thank you very much for your time.
So we have plenty of time for questions. You can submit them through the app. And while I'm waiting for questions to come in, Jorge, I want to ask you about the portfolios and 2 things. When I think about adding sort of non-traditional asset classes like you've discussed, it seems more appropriate perhaps for an accumulation client than a decumulation client. And how do you think about them in terms of the liquidity of that asset, and then demonstrating sort of the risk-adjusted performance to someone after?
I think it's key to align the cash flows of those investments to those of the portfolio or the investor. And a lot of these investments are cash flow producing. So marketplace loan it's a high yield type of bond. So you have healthy cash flows coming along the way. So that can help. Some of the real estate investments or farmland can also have cash flow along the way. So that helps. I think where it gets a little bit trickier is with those that are be art pieces or private equity that you just don't control the liquidity event or when that is going to happen. So then for somebody that's in distribution mode, it needs to be a smaller part of the portfolio because you need to manage that liquidity. I think the interesting thing is, and also the the tricky thing in having these interval funds or funds that are trying to access these is that they're providing liquidity along the way. But you need to think about how are these funds providing liquidity if you have a truly illiquid asset with no cash flow? Like that is going to drag returns, or something else is going to happen that may cause a distress at some point. So that's an important consideration. I think in terms of illiquidity, for high net worth investors, I think they underestimate the ability to hold illiquid assets, because the majority of them have cash buffers or they have emergency funds. It's not like they're going to need 10 to 20% of their portfolio in any one year or in a few years. So I think some of these investments, by giving up a little bit of illiquidity, there's the potential for increasing return and reduce the variability that Jim was talking about, and provide a much smoother ride along the way. So, something to consider. It's about the liquidity. I think it's about managing it and educating clients around it, and be mindful about how to align the cash flows and the return needs of the portfolio to those of that client.
Yeah. So some of the research suggests, especially around ESG, that in some cases clients are asking for it. Advisors are not necessarily offering that as a solution, in part because they don't feel as well educated about these topics. Now you're adding even more topics for advisors to become educated about.
Yeah. I think it's the reality of the game. I mean, you have all these platforms that are spending millions of dollars in advertising. They're catering to investors directly. So if we're not having those conversations, as the studies show, investors are going to access these directly. So where do you want that money to be invested, whether through you or totally separate, where it could be overexposed to risks that it may damage the longevity of the portfolio?
Right. And then in terms of excess returns, are you able to demonstrate to your clients that all this was worth it?
I think there are some compelling data points, and some of the interval funds I showed that own some of these asset classes have pretty compelling returns that are live. They're actual returns. So obviously, they're properly diversified and professionally managed. If you do it yourself, you get the risk of getting bad deals. I mean, I invested through the ground floor. Many of these platforms, I go in and it's almost like tuition. Put in $500, $1,000 is not going to break the bank if it goes wrong. But just having skin in the game forces you to look at it and pay attention and educate yourself on how it works. And like, for example, the ground floor platform, I'm still waiting to collect on some loans that I invested 2020 because they're going through foreclosure. Now, because I invested over 100 different loans, the overall return is still like 9%, even though I'm still waiting of a handful to collect back. So the return is there. Now you need to also diversify and do it properly to be able to get that nice return over time.
Jim, I want to turn to you for a second. So for much of recent history, advisors have used a systematic withdrawal approach to generating cash flow in retirement. You're suggesting something quite radical, I think, in many ways. Talk about how someone can make that transition from SWIPs to chaos.
Yeah, I think, I showed the one slide, and there's obstacles to creative thinking. One of those was the Einstein effect. And it's interesting because what it says is once you've seen a solution to a problem, it's hard to get it out of your head. And you're likely to try, if you have a similar looking problem, try to use the same approach. Systematic investment has been terrific, a great commitment device for accumulating wealth. And I think it's natural that people have tried to use it to solve for distributing wealth. And I think it's, again, as you see, just a little bit of active management is so much more effective in terms of extending the longevity of the portfolio. So I think you kind of have to bite the elephant one time at a time, one bite at a time, and that's you start with just the first year, and you sit down, and if you have these numbers to work with, and you have, like I said, if you're sitting on a possible 8% failure rate, historic rate, it's pretty easy to say, let's increase cash flow. If it's 48%, if their goal is to increase, then maybe you increase it 1 or 2%. But if their goal is legacy, then maybe you skip an increase. And I think that's where the art really comes into play. And then if you have, again, sitting on a 73% failure rate, I think it's pretty easy to show people, say, look, this is not a good situation. It's kind of like you talked about a health checkup, and it's like getting your cholesterol, triglycerides, and those different things. You show them you're in the range, things are looking good. And if you're well below the range, hey, go eat the Twinkies. The cholesterol is not a problem. But if you're well over the range, we need to take some action. And at some point, a good doctor doesn't start off saying, hey, you're going to die. They're going to try to suggest some lifestyle changes. And that's what this is about, is a little bit of we need a little lifestyle change, skip an increase this year. Maybe we can get one for you next year.
All right, so last question is, how many folks use Monte Carlo in their practices? Almost everyone. So Jim, you and I, we've had lots of discussions around Monte Carlo. Is there any role for it in decumulation? Any at all?
I just don't think so. There's one chart I didn't include that shows 1950 to 74, 50-50 portfolio average 7.2. And if you take a systematic approach at the end of 25 years, you had 103% of your investment earn the same returns in reverse order, and you ran out of money in 18 years. Now that's two ways to arrange 25 individual returns. If you want to calculate all the ways you could do it, it's 25 times 24 times 23, and you come up with a number that's 1.5 septillion, which is a 1 followed by 24 zeros. And in that scenario, if you're accumulating wealth, you end up with the same dollar amount each time. But for the retiree, you have 1.5 septillion different possible outcomes. And that's just the beginning, because that assumes you know what those 25 returns are. The day you retire, you have no idea. So there's truly, you have to know the individual returns. There's so many different returns you could have. You truly have an infinite number of outcomes. You cannot possibly calculate the probability of any outcome without knowing how many possible outcomes there are. Throw dice, what's the odds of throwing a 6? Well, it's 1 out of 6, you know that. But you don't know all the outcomes possible for a retirement income portfolio. But I just think it's an illusion of knowledge, and I think it's extremely important for communication and problem solving that you zero in on absolutely the most important aspects of a problem or your message. And you have to exclude all the noise, all the clutter. And great presenters, people like Churchill, they use very simple, concise language. Great problem solvers. If you're familiar with Occam's razor, that's all about zeroing in on the most fundamental axioms of any problem. So I just think it amounts to noise. I just don't see any real practical outcome for it.
All right, so we've run out of time, and I want to thank you for indulging our experiment here, and join me in thanking Jorge and Jim for a wonderful speech. Thanks.
Thank you for listening to the Exceptional Advisor podcast, brought to you by the Investments and Wealth Institute. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsandwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. For additional resources, updates on events, and exclusive membership deals, visit www.investmentsandwealth.org.
Did you miss out on attending this year's ACE Academy Conference in San Diego? Not to worry. This year's top sessions are now available on demand. Earn up to 21 CE hours and expand your knowledge with top-tier speakers like Wharton's Professor of Finance, Jeremy Siegel, or financial expert Michael Kitces. Register today at iwicentral.org/ACE23.